Hello everyone, this is Mark with Semantics Research with your daily report. So if we take a look at the last 5 days in the S&P sectors, defensives have been performing the best since the rate hikes, and real estate is doing also quite well since if the yield goes down, it could spur demand. Energy is doing the worst as the markets are more concerned about recession versus inflation, and it seems like they're also concerned about the regulations from the administration, which brings uncertainty. The oil rig counts have been increasing as that increases supply, and they are afraid of future demand destruction due to a potential recession. If we look back in history, like 2008, oil did crash from the highs because people thought it was the end and there was no more need for oil, as many people thought the whole global economy was going to collapse. Also, metals and mining are doing poorly due to a general commodities sell-off. Agriculture futures are also down due to recession fears, and the longer-term yields are going down, and the short-term yields are going also down, but at a lesser rate, which is causing a flattening of the yield curve. So many people are generally buying longer-term bonds as they're more uncertain of the short-term for the markets. And if we take a look at the real yields formula is the treasury yields minus expected inflation. If we take a look at the 10-year real yields in the past 5 days, we have been quite range bound. Generally, if the real yields go up, it means that expected inflation goes down or the treasuries went up, and you could also expect people to buy bonds over stocks. Yields can be thought as inflation expectations plus growth expectations generally, and the yield curve has been a predictor at the short end, as the slope of the short end of the yield curve is positively correlated with economic growth, and the more upward sloping the curve is, the more connected it is to a higher economic growth. And a general misconception, especially promoted by the general media, is that the slope at the long end, especially like the 10-year and the 2-year rate, is a predictor of recession, which empirical studies show that it isn't actually correlated with real GDP, but is actually mildly negative. Now, even the short end of the curve, this predictive power is still noisy, as its correlation is only at 29%. So it's not a perfect predictor of a recession or economic growth. Treasuries are also less reliable in predicting GDP growth since 2008, as the correlation has gone down. We can see that if we take a look at the empirical data, 2008 has been a structural shift, as it seems like there was some hangover from slower economic growth in the years after the crisis, and flatter yield curves, even at the short end, have been growing in correlation, have been less correlated with real growth. If we take a look at the PMI numbers, Eurozone has been showing that they have been contracting, so they are likely in a recession, and they will likely suffer a deeper recession in the US, as they're dealing with a lot more headwinds, like the natural gas situation due to the Ukraine-Russia war. And some highlights from the report was that the supplier delivery times were improved, but there was a slowdown in domestic and foreign demand and lower expectations for the future from firms, as well as price components moderating slightly. So you're seeing a little let off from the inflation pressures, but not really much, as you're still at the highs. So if we take a look at the US PMI, it signaled the weakest upturn in the private sector output since January slowdown, and the rise in activity was the second softest since July 2020. The decline in the index signaled a further easing of the rate of expansion in business activity, but the service providers have indicated a rise in output. So you're seeing a little bit of shift from goods to services. Manufacturers have shown that factory production has been slipping into a decline, falling at a degree which has only been seen in 2020 and 2008. So this could be this is like a leading indicator that could be showing that we may be in a recession. We also see a weakening of demand that was attributed to the rising costs of living and falling consumer confidence. We have also seen new exports contracting at a steepest pace since June 2020 as foreign demand for our U.S. goods have waned. Inflation continues to take its toll as input costs and output charges reflect this substantially, and input inflation pace has been slowing, and firms have stated that wages have been increased to incentivize workers to stay, since fuel, food, and transportation prices are much higher. And we do see output charges rise to a lesser degree as firms have been passing inflation costs to consumers. But we do have to note that there is an increase of discounting prices to encourage demand. Also, employment has been slowing as the rate of total job creation in this sector has been at the slowest rate. And we can see that the pace of economic growth has been slowing sharply in June, as we've seen with the data. And since we are seeing a drop-off in demand, price pressures have been thought to have peaked, but we are still elevated. And as effect of the PMI, we've seen that the rate hike odds were lower today, and a 10-year yield is down 10 basis points, as well as the TIPS yield being down 6 basis points. And with that being said, that is it for today's video. I want to thank you all for watching, and be sure to check out the link in the description for more updates.